But I suppose more seriously, closer to home itself, just essentially say the key message really is there's really truly a lot of noises in the market itself. And indeed, if you look at this year, almost habis already. But look at the market, hasn't done too badly. Remember at the start of the year, end of last year, we we're all warning about trade fight, we were warning about risk of recession. Yet look at the market, still chong, so don't listen to us, so seriously, you can't even tell what's going on itself. Okay, my handsome look up. Okay, suspender here. Today I thought I dress up because 10-year anniversary, so first time in 10 years I wear a suit. Disclaimer, nothing much. Okay, big picture itself, as you say, very quickly, because I think our panel will be more fun than me just talking solo up here. Just to highlight and just a reminder of what are the risks out there. This is more a case of President Trump risk. The more he tweaked, the higher the risk itself. So you can track it, especially from the 3 years ago when he was the president itself. So as you can see, we know all these things. We already can see those in businesses, those whose parents are working itself. They will probably remind you that things are slower out there. This is a picture of the slower growth momentum in trade. Singapore, it matters a lot. We are a trading nation, both for goods and services itself. Many agencies, including our Zheng Hu here, has cut GDP forecast. No difference. This is just again another reminder. But again, don't listen to us because we always say next year better one. So you see 2020, it's just to sort out. I tell my boss got gang zhou lah, so but we see how itself. But I think what has helped market sentiment to some extent, despite the President Trump and his erratic behavior, is that there are a lot of cheap money around itself, and central banks are making it cheaper. So that helps. Liquidity equals stock market buoyancy at the end of the day itself. And the first central bank to cut was the Chinese central bank, and we may see them being the last central bank to cut again this year as well, because the Chinese slowdown is another factor why we are seeing slower growth, because the two largest economy, US and China and the Eurozone, all experiencing slower growth. Within China itself, obviously, the deleveraging process of the policymaker is really about long-term sustainable Chinese growth. So it's adding on to the global slowdown overall itself. So no need to say all these things, everything just go down only lah. You see, you invert it, market go up. So it's loan. Itself. So straightforward. Essentially, what we're still seeing is we get used to bad numbers. That if anything we're saying, wow, last month the export dropped 10%. This month only 5%. Wow, chong ah. That's essentially what we're seeing with all the numbers at this juncture, which is why we have seen recession risk and increase went on about yield, etc. as well. So anything blip up is just essentially recession risk subsiding a little bit. I don't want to go through all these things basically because I think it essentially still shows that while global growth momentum is slowing down, we still see labor market, end of the day, it still all boils down to if people still have work, still got money in the pocket, still got time to save some, we keep the global economy going, although we may be eating and drinking a little bit less just because of uncertainty. And this is what we see. If the US labor market remains stable and positive, interest rate remain cheap, they will still spend to some extent, but we do see growth slowing down generally itself. Some sector more than the others itself. Retail trade being affected by e-commerce, etc., are seeing sharp slowdown. But modern services, those related to internet, e-platform, are seeing a lot more growth. Singapore growth, digitization, all these things, creating jobs within this area again as well. You are seeing far more growth opportunity for companies. But yes, recession risk has increased, but 30% is still boleh tahan at this juncture itself. Okay, China, obviously, we know that it is both being impacted by weaker external demand and also domestically, also deliberate engineered slowdown as well. We saw that in terms of car sales as a function this week. We saw retail sales, industrial production, money and banking, but Obviously, October data get affected by the shorter month because it was a festive month itself. But still, it's still selling cars, but it's just a lot less than before. So what we do see, generally speaking, is a managed slowdown as far as China is concerned itself. So we'll see to what extent if the slowdown accelerate or decelerate further for them to do some more itself. So they've been calibrating, spending more money and collecting less taxes itself, cutting interest rate, and all these things. So we'll see. Well, every day we continue to see the two sides talking about trade fight, trade war, or on pause for now. But we know that this is not going to go away anytime soon. But in the event that they do agree to pause for now, that's good enough for the market to chong again. So even though we know that you probably may not last very long in terms of truth, both sides do need some say that some sort of a breather, but we don't know how much of a breather they can actually get itself, because growth have been. I won't go through all these things. Essentially, to come down to, I suppose, this one thing here itself. That all these things for us here in Asia, we're already seeing the numbers weaker. This manufacturing condition softer in a sense. So nothing new on that front itself. But we essentially say, despite the more tough environment in this environment, we still see at least more supportive labor market condition. We do see central bank being more supportive. We do see more Zhenghu around the world spending more money than collecting. So that's helpful at the same time. So which is why this is the kind of ideal growth that we were to see going forward. So we'll see again, 1 year time, we'll see what will happen for now. But we certainly can say that perhaps the worst is over in that the rate of contraction, because if you slow down from 50% to 20%, the base becomes smaller and easier to get some growth from as well. So perhaps what we may see at this juncture is things essentially slow down to what we call an extended trough. It's just weaker, but not weakening any further, which is good enough for, I think, global economy or global markets to see. For us here in Singapore, I suppose the key thing really is about whether the tech sector is coming back. I think those who have been in the market the last 2 weeks here have suddenly seen all the tech name in the SGX, Chong, so perhaps, this is just a picture of why, some of them are doing a bit better on expectation that maybe it's just less bad in terms of the global chip sale. Bottoming out is minus 30% in terms of so if there's no recession, it cannot possibly be another minus 30%, right? It's just less bad. Less bad is good enough. This is what we're seeing. I think we're seeing that in all the figures as well. This is Japan semiconductor sales, less bad, just plateau out itself. Taiwan export orders, no longer minus 10, it's just minus 5, Next week, minus 2, wow, good. So less bad is good as far as, so we can see that. So this is another one, the billing, less bad, North American headquarters manufacturer, so semiconductors equipment itself, also less bad. It's still everything less bad. So tomorrow, next week, just go to the stock market and see the less bad tech sector doing another sign, Chong as well. So we'll see, essentially, which is why there are a lot of noises sometimes behind this, but essentially we say, is the worst behind? The expectation certainly is it at this juncture. So I think this is what we're seeing, because the expectation is that things are not going to get any worse. Central banks are on standby to do more. Government are on standby to spend even more itself. We've got the market which been going up and down when Donald Trump in his bad mood and up when he's in his good mood, or whether he need money for re-election, also different things also lah. He need to stock up, and he got impeachment hearing to jaga as well. But as Chris pointed out, I think this is another way of just looking at things. If you look at our SGX itself, up and down around the 3,000 level, if I were to put this in the 100 level itself. Anytime it dropped below the 3,000, he said, mother and father just buy everything up. When it goes to 3,003 there, okay, maybe take a bit of profit. So that is essentially, I think, the end of the talk for now, in that there are still lots of noises out there with the market itself. But if you do have time, stay invested. It's quite profitable, which is why the chart of Chris earlier said they're actually more green than ang in the market as well. It's just Wow, even this one bolat liao. So on that note, I will basically stop here lah, because this is the last slide in terms of the investment strategy, in that you stay invested, but when you are in the late stage, slower growth environment, it can be more challenging itself. But we think because so many people are watching things on the sideline, any downturn will probably be quite brief, unless you talk about a big external shock itself.